Hello and welcome to another Switzer update on January 30. And some interesting news coming out of Beijing where they've banned online learning from universities outside of China. Now, this has really made a lot of Chinese students panic about their courses, which they've been doing online since COVID. 3,500 have already arrived in Australia, but there are 40,000 visas for students out there. And these people could be coming in a real rush over the next few months. Now, this is great news for landlords of apartments in the inner city areas where a lot of the students used to live and around universities as well. It'll push up rents and property prices in these sought after areas for students. Now, what's interesting is that Chinese students provide something like a third of the total education income that comes from Australia. And we're talking about $12 billion. Compare it to wool exports, only 3.5 billion. So this is a really important stimulus piece for the economy at a time when some people are worried about what's going to happen to the economy. In fact, Morningstar's hotshot expert recently put out a report saying that he believes that the RBA might have one or two more rate rises to go. But when all those people roll off their fixed home loans around the middle of this year, he reckons it's going to lead to the RBA being the first bank in the world to actually start cutting interest rates. So, the positivity from the students coming good for the economy, but he believes that the economy will really suffer in the middle of the year because of lots of people having to pay lots more money to make their home loan repayments, and that means they'll stop buying retail goods, stop travelling and whatever, and the economy will slow down. Let's have a look at the stock market for the rest of the week. The Dow was up 28 points on Friday. NASDAQ was up nearly 1%. That's a good sign. Tech stocks are still liked over there. Our market is expected to open up about 12 points in the positive. The Aussie dollar is 71.06 US cents. And the big news for this week is, first of all, the Federal Reserve's interest rate committee meets in the middle of the week. It's expected they'll do a 0.25% rise, which is a small one for the Fed. But it's going to be the size of the rate rise and what the Fed says, that narrative that comes out, that's going to be either a plus or a negative for the stock market. The stock market's done really well this year, a fantastic start to the year. And invariably, if you have a good start, January, it usually rolls on for the rest of the year. Not in a straight line, but over the course of the year, it's usually a positive sign. Now, what's interesting is that on Friday, the personal consumption expenditure price index was released in the US. Now, this takes out jumping type costs like food and energy and focuses on the real core of inflation. It only went up 0.3%, less than expected in December, 4.4% for the year. That's the inflation number that the Fed prefers. They think it's a more reliable one. It's down to 4.4%. So this suggests to me that provided the Fed doesn't do anything really mad, bad and dangerous with their narrative around what they're going to do with interest rates. And then on Friday, if the jobs report continues making the inference that inflation is falling in the US, that's going to be good for US stocks and therefore good for stocks here in Australia. So it's going to be a make it and break it week. Bad news from the jobs report or from the Fed will turn this around. I don't think we'll go anywhere near our June or October lows, but still there will be some profit taking if there's some fears that come out of either the Fed report or the jobs report. But before we go, let me just share this with you, which came from JP Morgan recently. And they got a reasonably positive outlook for bonds, definitely for bonds, and stocks like tech and industrials. They favour them over the course of the year. But this quote is interesting, and this is the quote: "Historical evidence suggests that the real economy suffers the greatest damage after interest rates have already risen, but markets may have already reacted to higher rates and their consequences." I think that's what's going on now. The market is starting to look down the timeline, the time tunnel, and it's saying to itself, okay, problems for the economy will keep going as interest rates rise, but we're near the top. And so it might be the appropriate time to start taking chances on companies that have been beaten up over the last year or so. I think we're seeing it, and only some strange curveball from left field will change my point of view. I think we're heading in the right direction for stocks. I don't expect it to go up in a straight line. There will be some sell-offs, but I think there'll be a lot of buyers interested in buying some of the really good companies that have been beaten up over the last few years. Companies like Tesla in the US, Amazon, Google, all the ones that we use on a daily basis. And similarly, the really good companies in Australia as well that have suffered as a consequence of the tech and growth punishment that came with higher interest rates over the last year. So that's my report for today. Talk to you tomorrow.